A splendid evening it is to you viewers. Welcome to Equity News and Equity Access, your business and economic insights in Zimbabwe and beyond. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get to business. The Zimbabwe Consolidated Diamond Company, the ZCDC, has entered into a joint venture with Russia's Alrosa. Under the agreement, Alrosa will channel $12 million for diamond exploration in Zimbabwe. The joint venture is expected to enhance skills and technology transfer, as well as create income and empowerment opportunities in mining communities across Zimbabwe. ZCDC is wholly owned by the government, having been incorporated in 2015. It recently acquired mining claims in Chimanimani, where exploration works are currently underway. Now let's just have a look at the feed from that post-cabinet media briefing where this deal was actually put onto the table. Let's have a look.
The signing of a memorandum of agreement between Zimbabwe Consolidated Diamond Company and Alrosa of Russia, the largest world producer of rough diamonds by volume, marks the beginning of a business partnership that will enhance the accomplishment of Vision 2030 and is in line with the National Diamond Policy. Ladies and gentlemen, joint ventures are a strategic investment tool that allows the partners to pool capital and resources to unlock value and create wealth. On the one hand, Zimbabwe has vast potential diamond resources across the entire country and a pool of highly qualified personnel. On the other, Alrosa has a wealth of experience and skills in diamond exploration, mining, processing, and marketing globally. In addition, Alrosa has a proven track record as a joint venture partner in the region and globally. In our assessment, Your Excellency, this partnership will enable Zimbabwe to become one of the top 5 rough diamond producers in the world within the next 5 years. This will create more value for the country, government, and other stakeholders, resulting in the rapid development and growth of our economy in line with government's Vision 2030 as enunciated by the President of the Republic of Zimbabwe, His Excellency. The signing of
Who is Alrosa? Alrosa is the world's largest diamond producer by output, accounting for 29% of the global diamond output. So this could actually mean a great deal of potentials where their engagement with Zimbabwe is concerned. Now, before we get into a second clip, let's just have a look at Zimbabwe's output over the past few years, moving right from 2010 up until 2017. In 2010, Zimbabwe, this was of course Zimbabwe's production, producing 8.4 million carats, which was in value $340 million. In 2012, where we reached our peak, producing 12.1 million carats, as well as $644 million in value. This is of course the time during which we were benefiting from the alluvial deposits in Marange. Now, as we see the graph going on a downward trajectory, this is now the depletion of those alluvial deposits, moving right to 2.5 million carats in 2017, as well as $175 million in terms of value. Now, with Alrosa coming on board and seeing to that they meet the terms of the MOU, this could actually see a drastic change in those stats and perhaps have us move back to these particular figures. Of interest would be the fact that Alrosa, they come in with sophisticated equipment, they bring in the resources, they bring in the expertise, they bring in everything that they've got to ensure that they scale the production with ZCDC here in Zimbabwe, and that could potentially ramp up the figures. Now let's get back to that feed and have a look at the head of the Russian delegation explaining to the president the implications of this potential of this deal and the potentialities that actually come with the deal. Let's have a look.
We're very grateful, Your Excellency, you visited our office. You saw that we do not only produce diamonds, but we also bring value by proper mechanisms of sorting, marketing, working with rough coming from different regions of Russian Federation. And we are absolutely sure we can bring the same value to Zimbabwe diamonds. We are very grateful to your personal support and involvement in creating this GV joint venture, and we're also very grateful for Minister of Mines, Winston Chitando, your team, the management of ZCDC, all the people who were involved, because really in a very short period of time, without any bureaucratic issues, we actually came up to the signing of this document. We are sure that within a couple of months we will keep the same pace, okay, the same speed, and we will already start delivering the results which will be beneficial for the government of Zimbabwe, people of Zimbabwe, and soon you will see the effect. We are absolutely committed to bring all our expertise which we have, and also we are planning to work here to operate
in order to ensure that we succeed and we continue to grow. We are also diversifying our business model. We are going to start this year.
African Economic Development Strategies Organization has called for a liberalization of the Zimbabwean agricultural market. The nation is currently grappling with food security matters following the cyclone Idai, as well as the drought that affected the agricultural produce during the course of the 2018-2019 rainy season. As such, Fusionist estimates that a good 5 million Zimbabweans are in need of food aid. Meanwhile, the AEDS believes that a liberalization of the Zimbabwean agricultural sector would improve Zimbabwe's efficient allocation of agricultural products. Now, we had a close up with the executive director of the entity, Dr. Gift Muganu, who gave his thoughts on the subject after issuing a state of the agricultural industry earlier on in the year. Let's have a look.
I think the figures which are out there is that 6 million people are in serious shortages of food. So we are food insecure as a country because of the effects of the drought which we witnessed during the 2018-2019 farming season. So we are not looking good. But again, this is over and above of our inefficiency in the farming areas, where traditionally we're importing cereals every year, $500 million for the last 10 years or so. If you look at maize, soybean, wheat, there is a price control. You hear cabinet sitting down to announce the prices for those grains. And the moment you put the price controls, you are distorting. Price controls don't work. You take away the incentives, you take away the innovations, you put a lower price to subsidize or a higher price. At some time, our price was 3 times higher than the regional price in the US dollars. So companies were much more prepared to buy from Zambia, where they were charging $137 per ton, than to contract someone and buy at $390 a ton at that point. So what do we need in the agriculture sector? We need a commodity exchange for the grains. And for your information, Zimbabwe has got a commodity exchange, which is called the Commodity Exchange of Zimbabwe, COMEZ, which was launched here at Rainbow Towers in 2010, February. The Minister of Agriculture is adamant. They don't want to liberalize commodity grains because I feel, you know, when you are the policymaker, you are the one who decides the price. You're also the farmer. It becomes a problem. You have fears, naturally, that if I liberalize, I'm not going to be able to make this profit because they have to be productive. You see, so it's a fear of production. So they are holding on to a problem which is eating them. I think
Edgar's parent, Edcon, based in South Africa, has disposed of 104 of its stores to another retailer, Footgear, for an undisclosed amount. The deal was announced by Footgear as well as the Old Mutual private equity entity on Monday morning. The OMPE last month became a majority shareholder in Footgear. Now, the move follows a debt restructuring exercise after Edcon found itself in trouble late last year. It also comes after a recapitalization deal worth over 200 million United States dollars. And so, of course, the firm is looking to bring efficiency or enhance efficiency across all of its operations. Edcon owns a controlling stake in Edgar Zimbabwe, where it increased its shareholding earlier on in the year from 38% to 41% in an exchange of shareholding for the control of Edgar's as well as Jet Brands by the Zimbabwean entity. Moving on, Kenya hosts the first ever Afro-Asia FinTech Festival. Kenya Central Bank partnered with the Central Bank of Singapore in organizing the event. Now, just to jog your memory, Kenya is responsible for the launch of M-Pesa, which has revolutionized the face of FinTech across the continent. Of course, Econet launching EcoCash was following right in the footsteps of M-Pesa, which is based in Kenya. Kenya has also made substantial advancements in fintech in the past decade. As a result, the percent of Kenyan adults with access to formal financial services has improved from 27% in 2006 to 83% in 2019. Just in, Christine Lagarde, the MD of the International Monetary Fund, has submitted her resignation to the fund effective the 12th of September 2019. This, of course, comes on the back of her trying to make way and pave way for her to assume her new role as the president of the European Central Bank, which of course will see her run the monetary system for the European Union. Now, this concludes our evening news bulletin. Up next is a look at the news under News Review. Don't go anywhere.
Climbing to the top takes more than just hard work and smart choices. It's the passion that drives you from within, the endurance to keep going through difficult times, and having a very clear vision of how to succeed. That's what we strive for at CBZ. We're a diversified and innovative listed financial services group in Zimbabwe, with a complete range of activities, including banking, short and long-term insurance, asset management, and property investments. CBZ has been a pinnacle for stability in the economic landscape of Zimbabwe, stemming from our deep-rooted values, our excellent customer service delivery, and our corporate vision to strive for excellence as a global competitor. Our continuous investment in research and development will cement our promise to provide customer convenience utilizing state-of-the-art technology. Relationships are at the core of what we do. We understand, however, that strong, long-lasting partnerships are not built overnight. With over 3 decades of wealth management, we have come to understand our clients and their specific investment requirements. Our unique mix of skills ensures that investment opportunities are examined from all perspectives. The balancing rocks of Zimbabwe have weathered the elements for thousands of years and stood the test of time, like majestic reminders of the fine balance of nature. They challenge our perception of what is possible and what endures. Just as CBZ has weathered the economic storms and remained steadfast throughout the turbulence of unsettled economies. Achieving the impossible through resilience and stability, we balance the elements of hard work, dedication, and experience, making us your ideal partner for success.
Welcome back, viewers. It's now time for News Review. Now, just coming in from the post-cabinet media briefing is the fact that tourists as well as mining companies will now be required to pay for their electricity in foreign currency. Now, to discuss these and other issues, I'm joined on set by our very own economist, Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Thank you, Eben. Good evening, viewers.
Superb. Now, of course, let's start by talking about what is coming in from cabinet. The tourists as well as mining companies will now pay for their own electricity in foreign currency.
I think the statement from the cabinet actually was saying the tourism operators who are operating in Victoria Falls should pay for the electricity in foreign currency,
which in essence means that tourists now pay for.
But if you look at
indirectly,
yes,
no.
But if you look at Victoria Falls, it's much of entirely a foreign currency, a foreign currency city there because of that tourism activity that happens there. Much of the activity is actually driven by foreigners, and foreigners, I think, they account for 90% of tourism revenue from that perspective. But if you look as well at the issues to do with electricity. It's not an issue of production, because in terms of production, there is nothing that we'll be talking about since Kariba and our own Wange power station, we don't produce that much. So much of our electricity requires foreign currency, since we import it from South Africa and from Mozambique. So I think it's actually a good initiative, especially if there is that buy-in from the industry. I think the industry and the private sector as well, they have to cushion the government somehow, because we are in a crisis and we need some of those measures to move out of that crisis. Then for mining companies, the government actually has opened up a window to those players that can import electricity on themselves. They are saying that they can actually purchase that electricity directly from the Southern African power pool. If you look at Southern African power pool, it's actually a consortium of all the players in the electricity industry in Southern Africa. It's actually headquartered here in Zimbabwe, in Emerald Hill. So I think it's a welcome policy move. Is a welcome policy stance, and I think the government is actually moving away from its previous stance that ZTTDC will be the sole buyer and distributor of electricity. So if I think a company purchases directly from Southern African power pool, there will be that that thing that you're actually aware that you have your electricity when you require it. Some of those mining operations which involve those huge scale or large scale equipment, some of them they really need electricity, and when a blackout happens, to actually get back into business may become more costly. So I think it's a welcome move, and I think it will keep production flowing.
I cannot help but imagine what the setup now will be, considering, there is the whole 50% remittances by government where the foreign currency generated by the miners are concerned. How will that play out? Has there been any indication yet, or that remains to be spelled out?
There hasn't been any indication yet, but my thinking is that those players that now have a foreign currency component in terms of their cost or in terms of their production process, I think now they have that direct thing that they can go to the RBZ and actually negotiate for a better deal in terms of foreign currency retention. So I think the government, even through the RBZ, they would actually accept such excuses or such scenarios.
Would this improve the situation in terms of the output from the miners? Would it? What would be the aggregate impact of this move?
If you look at the dynamics to do with electricity is actually a very critical component in your production process. When you don't have electricity, most of your production, you can't do it. So I think the government is now realizing that we are headed for a deeper recession. For us not to bottom up in terms of that recession, let us maybe introduce some of those measures that would encourage production. So I think, to me, it's actually a positive step that has been taken by government.
Positive step, you say?
Yes.
I realize now. How positive is this move here, where we are actually seeing Alrosa coming on to sign an MOU and exploration rights to the tune of $12 million? Would you want to shed more light with that is concerned, as well as the significance thereof?
Alrosa is actually a very big player in the diamond sector in the world. It's actually positive, and it sends positive sentiments there to the investment community out there. But if you look at the issues in our diamond sector, to me, some of the issues were much to do with transparency and lack of equipment. So if we can attract a player who has experience like Alrosa, I think it's positive. But I also think the government should improve in terms of institutional framework, in terms of law, in terms of policies governing diamonds. To me, I was actually thinking first that we need a policy overall. If you look at platinum and diamond, those are the only two two sectors that are still, affected by that indigenization and empowerment laws. And if you look at indigenization and empowerment laws, they have been, an albatross in terms of attracting investment. People or investors, they don't need, that restriction in terms of equity. That 49.51% kind of setup, I think it doesn't, augur well with much of those people who would want to inject their equity. If you look at diamond and platinum per se, those are actually, long-term investments, and I think they have got, a longer term period for you to break even. Maybe you might need 10 years or so for you to start to reap your investment. So those 51% kind of setup, I think the government should also have to relook at it, maybe lower the ratio, maybe to levels like 20-80 in favor of the person who is injecting capital. So if you look at the issues at Marange and Chiadzwa, we no longer have, those alluvial deposits, and we now have that deeper lying resource. So I think we really need that sophisticated capital and technology, as well as, the know-how to extract such deposits. Then in terms of the figures, out of it, I think diamond, according to the last report that I read from the Ministry of Mines, they were saying that diamond needs something around 500 million capital injection for us to produce 7 million carats per year. So 12 million, yes, it's positive, but for us to move to the levels of 500 million, there should be proper policy consistency, as well as good institutional setup and clear arrangements. And I think the government should actually use this deal as an example that we are really open for business.
Right. What could that spell for Zimbabwe's figures? Do you think that would ramp up the figures? Do you think that government would actually follow through? Remember, previously we've seen government sort of opening a window, and then in no time that window is shut. There's a quick shift in policy, and these foreign investors actually pull out. Are we going to see any change?
We might see any change, but we shouldn't expect, the quick results, because mining investments, sometimes they tend to take longer for you to reap up, positive results. 875 there, we might see at 2.5 there. We might see our production coming up, but we shouldn't expect it to happen over a period of lesser than 2 years.
How much time?
So to me,
5?
I think maybe 5 years, after 5 years or so, but 500 million as the industry requires, I think that's actually a huge call there.
So the 12 million is but a drop in the ocean.
12 million as a percentage. If you compare it to 500 million, 500 million will actually take us out. It will actually take our production to 7 million carats, which is your 2011 levels there. Much like your 2011 levels of production. But if you look at the difference between now and 2011, in 2011, 2012, 2013, we were mining those alluvial gems, which didn't require much capital injection, as well as much time to extract them. But right now, the situation is totally different. You have to dig deeper. You now need better equipment, and you also need better know-how as well.
I realize. Now let's talk about what Dr. Gift Mugano said, that he continues to climb. Of course, this is not the first time that he has said this. He issued an agricultural sector report earlier on in the year, and he still maintains his stance that Zimbabwe needs to see to it that it implements a liberalization of the agricultural market. What is your perspective where that is concerned?
First of all, if you look at the agriculture sector, we might maybe need to dig into the subsectors per se. If you look at the subsectors, to me, I think there are only two subsectors that are not liberalized, which is your cotton as well as your grains. Why is your cotton and your grains not liberalized? Those are the sectors, the subsectors where the government was trying to cushion them and to cushion the farmers. We have seen that when the government actually liberalized the agriculture sector, most farmers tend not to undertake, your grains and cotton production because of lower prices. So the government actually protected or intervened in that sector through subsidies and controlling, the producer price as well. So I think for maize and other grains, looking at the levels of production currently, for this year, maybe we're expecting something like 745,000 tons. I think we still need greater government oversight and greater government involvement. If we liberalize that market, if we liberalize that sector, I really think that we might see most of the farmers shunning that production, maybe getting into much more lucrative crops such as the tobacco and the booming horticulture. Horticulture is actually a promising subsector of the agriculture sector, and other, activities such as your macadamia. I think they are actually sounding a bit lucrative there. So opening up, your grains, and considering that Zimbabwe we depend much on maize, I think for now it's not the right time. But maybe if the productivity has improved and if institutional setup is actually improved, I think maybe that's when we may say let us implement that. But moreover, I've seen most of your grains and other cereal crops, there is greater government involvement in terms of production as well as regulating the marketing itself.
I tend to agree with you that maybe we may need to look at this idea, perhaps getting into the future.
Maybe if we were saying that we have a market problem, that's where we will say let us liberalize. But for maize, I don't think it's a market problem. It's actually a production problem that we have.
But quite a conundrum. Government is the one that's issuing the inputs. At the same time, government is the buyer. For example, in the maize sector, how does that work? Is that not bleeding the economy? I was reading Eddie Cross Perspectives today in one of the local newspapers, and he was saying, look, we cannot continue to sail on this whole subsidy trajectory. Letters of credit on the fuel side. We also have the 38% subsidy where the grains are concerned. Does that not, in a way, impinge and infringe on Zimbabwe's ability to move forward as an economy?
I can't say that the government is bleeding the economy per se, because if you look what over governments actually subsidize agriculture. When the government, purchase inputs on behalf of farmers, they offer those farmers inputs as a loan on the condition that they will deliver all the harvest to GMB if it's your maize or other grains, then to Kotco if it's your cotton. But then the 38% price or price discount that's being given to your millers, I think it's a sign, or it's actually an intervention by the government to try to cushion the farmers such that they'll get a lucrative price so that they can get back to the field. If you look at what was happening in the agriculture sector, we have seen prices of maize when they were still at 350 per ton, thereabout. Your price of fertilizer, your 50 bag of fertilizer, that time around in October last year was around $20 per 50 kg bag. But right now, the price has gone up. It's now costing on average 700. Some there in some shops it's 500. So a farmer now he has delivered his or her maize to GMB. If the government had remained at the previous price level, it means that you could not go back to the field, or he would shun that crop and maybe look at other lucrative crops. So implementing subsidies and what the government is trying to do, I think the government is trying to say that, okay, let us improve our productivity, or let us improve the level of production of the key crops, which is your maize, such that we lessen the import burden and we save on foreign currency. If the farmers actually implement and we improve in terms of productivity, then we become more, self-sustaining. I think on the balance we'll be able to save on foreign currency and use that savings for other important commodities such as your petrol and diesel. So to me, what the government is doing, I think is a good policy. It's actually a right policy which needs to be improved in terms of efficient distribution of those inputs. What the government should do now is maybe to try to have a database of the farmers, then to say, if even you are a maize farmer, how many hectares do you want to allocate towards maize? Then you auto calculate that, yes, if you want to channel or you want to put, let's say, 10 hectares under maize, you need so much amount of maize seed, so much account of chemicals, so much amount of fertilizers, and so forth. Then the government will actually give you a target that in terms of your yield, your target yield maybe will be, say, 5 tons per ton. Then we'll actually know that Iben will be able to deliver so much quantity of maize to GMP. Then the government should also be strict in terms of following up on deliveries as well. But the missing link in terms of this financing model by the government, to me, I have seen that it's to do with insurance. We have seen that there is no insurance package in terms of the whole financing model. Then we rely on weather, on rain-fed agriculture. So whenever we had an adverse climate condition, that's when we see production falling short, and actually on balance the government losing out. Then that's why we are seeing so many people trying to complain and saying that no, the government's model is not right or something like that. The government maybe should try to see on ways to accommodate or to implement an insurance package on top of its command and the presidential input scheme.
Interesting. Well, thank you, Tinashe, for the perspectives. Thank you very much for staying with us. Up next is a look at markets daily with Anisa Chumbomu. Don't go anywhere.
Ladies and gentlemen, welcome to Markets Daily on Equity Access. My name is Anesu Chimbumu, and let's get the ball started. Now, bulls emerged to maintain broad gains on the stock market today, with the stock market hitting a second session running with positive gains. Now, the stock market was characterized by about 31 counters that did exchange hands today, 9 of which were bulls and 5 were bears, leaving us with a market breadth of 4. Now, there were a couple of movements within the top 10 index, which pretty much showed a heavier weighting in terms of index movements today, where the top 10 index had added 0.59% for it to settle at 183.81 points. Now, this movement was much consequent to an Econet jump of 1.25%. Now, Econet didn't make such a huge jump today, but volumes traded for that counter did amount to 10 million shares being traded on the stock exchange. Now, these 10 million shares did account for about 70% of the 764% gain in volumes traded from prior session, which is pretty much 10 million off 14.5 million on the stock exchange today. Now, mining's index did finally make a movement today after about 6 sessions of its sailing pretty much stable, adding 0.94% for it to settle at 251.30 points, for it to be about 10.36% ahead of its year opening levels, while the old industrial index and the all-share index settled at 641.73 points and 192.33 points after having added 0.49% and 0.51% to its point levels. Now, on a week-to-date basis, we seem to be extending our weekly gains, 1.43% for the all-share index, 1.44% for the industrial index, while the top 10 index is now up 1.72% and mining's index is up 0.94%. Consequent to today's movement. Now, General Beltings was the leading counter in terms of bulls today, adding 20% for it to settle at 2.88 cents. Now, General Beltings is pretty much a penny stock, which has 2 divisions within its business, one of which is chemicals business. The chemicals business, which has a subsidiary named Cerno, did enjoy an increase in their revenues, even though their volumes did come off. Now, volumes for that business on both of the divisions did come off. Also, for the rubber division, they did experience 11% dip in their volumes. Now, this counter is only just about a $4.8 million revenue making company. Pretty much did come off from its prior year's financial performance in terms of its revenue output, but even though they did have an increase in their gross profit, much to do with them being able to improve their product mix for most of their products that they do serve their customers with. Now, OK did add 13.66% to settle at 45.59 cents, while Meikle's Mash Holdings and Truworths did cap the set of top 5 risers, adding 9.09, 4.17 and 3.63%, all in that respective order, while Art did let go of about 15.79% for it to emerge as the worst performing counter today of the 5 bears today, for it still at 8 cents. Interestingly enough, Art is a company that owns Softex as one of their products. Eversharp is also underneath that counter there, so you may need to look at how their business model is pretty much set up for them to be able to somewhat survive for quite some time, especially with those 2 products being in play. Now, Edgar's settled at 18.01 cents today after having let go of about 9.95%. Star Africa, Axia, and Cassava did lose some value from its prior session share prices, coming off 2.17%, 1.66, and Cassava then capping off that set by coming off 0.0004% in that respective order. Now, for our interbank market versus the parallel market, they are pretty much almost in the same wavelength, even though the parallel market did seem to weaken a little bit today, with some trades going as high as 9.45, but we do still have a very low cash rate, which is around about 8.5, and some as low as 7.8. Now, with those averages, it will then only settle that counter at around about 9.1, while the old mutual implied rate has settled at 9.98. 9.98 to the dollar, while the interbank rate has continued on a very minimal weakening path for it to settle at 8.82 to the dollar. Now, for before you forget, we do always have a quarterly paper that reviews the economic performance of the country, and also an outlook that stretches out into 2020. Now, for such kind of information, we do issue out an invoice with that paper. With regards to that paper, I could just give you one highlight. I did mention yesterday that we are expecting for our yearly inflation to close out in December at around about 373% thereabout. Much to do with a lot of expectation that may come from pressures of the government having to print a lot more money than they expect to actually utilize within the remainder of the of this year. Now, for you not to get lost in terms of getting in contact with us, do not forget to like, follow, and subscribe our YouTube, Twitter, and Facebook accounts at Equity Access, and do visit our website www.equityaccess.net. Good evening.